allow me to see you on screen, then it'll make for a little bit better communication. So there's a stop video icon, or I guess, let's see. Hang on one second. Oh, okay. There's an icon and it will say start video on the bottom left. So if some of you want to do that, it makes it a little bit more interactive for me. And I can ask questions like, can everyone hear me? And actually, I'll open up the chat too. We got 9 people joined so far. All right, hearing somebody. Up to you if you want to unmute your. I finally see somebody. Scott, hi. First person to.
For the record, my son was using Zoom. He had a party. That's why my name is Crazy Nacho Face.
Oh, I was wondering who that might be.
Yeah.
Okay, I'm glad it's not somebody getting a free lecture. All right, I'll just wait. Let's see, 2, 6, 8, 10. We got 11 people joining, so I think let me just give it another minute or two. I'll show everyone my Stanley Park mug. Stanley Park in Vancouver, best urban park I think in the world. Actually, it was rated, so highly recommended. If you haven't been to Vancouver, it's a lovely place. Okay, it's 2:01. I'll wait one more minute to see if other people are joining. And again, if you you certainly don't have to let me see your beautiful faces, but if you do want to, so far I only see one person, so at least one person live. So if you want to start your video, it's nicer for me, but no big deal. So, all right, doesn't look like anyone's joined in a little while, so let me go ahead and start. So the first thing is the midterm. I've graded almost all of it. I had hoped to finish it and give you your grades and feedback before the lecture today. I'm probably need maybe an hour to grade. And then I actually still have to figure out the system which allows me to share your grades with you. So that's something I'm learning from the IT people. So I think by tonight you should have your midterm grades. On balance, I was happy with what you guys did on the midterm. I actually wasn't that happy with the exam that I constructed because it was frankly designed to be a closed book exam, and it wasn't really until probably less than 24 hours before the exam started that I realized it was going to have to be open book. So that meant some of the questions were, essentially recall. And obviously it's not very hard to recall something if you got the notes in front of you. So I got a few questions where, sorry, there's 2 people joining. Let me just wait a second to let them join. Almost everybody now. So welcome, 2, 4, 6, 8. We have 15 people. Okay, so what I was saying about the midterm for those that just joined, I think people did reasonably well. I had to switch from a closed book to an open book exam at the last minute, and I just really it takes a while to think of good open book questions. So some of the questions were kind of residual, just like I was saying, recall questions where you could more or less just type in something from the material that was presented. So some of the questions like that, I tended to get a lot of answers just echoing what were in the PowerPoints. Sometimes that was okay. Sometimes it wasn't. There, in particular, there was an essay question asking you to kind of describe the conditions of countries coming out of World War II, and then how that connected to the positions of Britain and the United States at the Bretton Woods conference, and a lot of people just kind of took what was in the PowerPoint slides and repeated them. The problem with that being is the connections weren't really made that clear, so it just read like what it was in the PowerPoint, which was a list of bullet points. So for people that just kind of copied what I had in the PowerPoints, it didn't really show convincing evidence that you understood. So you may have gotten a few points off for that. There was one question which I have set before in an exam, which is the one about Gilligan's Island. Gilligan's Island, for those that don't know, is an American TV show. I see Scott knows that one, right? I don't know if this made it to other countries, but anyway. But it's a nice example. Economists often use sort of island economies to think through questions, and that particular question caused a lot of people to problems to people. A couple of people did get it completely right, which is heartwarming. But so those were the two questions that kind of stand out to me. So anyway, I will be done grading them. I think I'll finish tonight, and at the latest, you should get your grades tomorrow. So if there's any other general questions. Oh, yeah. So the recording that I made 2 weeks ago, I actually didn't post it because I thought that probably everyone had actually participated in the lecture, but I guess there's no reason not to post it, and a student asked me about it, so I will. It takes, I think, about a day for me to get the recording, and I just got really busy, so I will post that. So, so the second homework is due, I think, today, right? So I don't know if people have all handed that in, but if you haven't, you'd still have till midnight. And then the third homework will be based on the lecture that we will get started in the second half today, and that's about the government accounts. And I'll try to post that homework in the next day or two, and that will be due 2 weeks from today. So that's it. We can start with the lecture. I don't know if there's any questions or issues. Yeah, one other thing. In terms of, so the last class is April, I think the date is 28th, whatever that Tuesday is. And then there's a week study, whatever it's called, study period. I will use that week to do a review session, unless for some reason something happens and one of the next 3 lectures doesn't come off, and then we'd have to do it as a makeup. But otherwise, I will intend to do a review session for the final, and so we will see how that goes. So I hope everybody's well, and if anybody have any questions, either you can use, again, the group chat, or you can unmute your microphone and just blurt out a question if you'd like. So give people a few seconds if you have any questions, otherwise we'll start. Okay, and thanks to those who started their video. So, all right, so I have to share the screen, and make sure I share the right screen. This is it. And hit share. Okay, so, all right, according to I take notes after each lecture, and according to my notes, this is actually where we were. I thought we'd actually gone over this. I don't know if anyone recalls where exactly we were, but I think we at least finished this one. So I was talking about the analytical presentation of the balance of payments. By the way, for those, well, Scott, I can see you. Can you see the cursor? First of all, can you see the PowerPoint? Okay, and can you see the cursor moving around or not? No? Okay.
It's weird. I don't see it, but with in my other lectures, I have been able to see it. So
Yeah,
I'm not sure why.
Yeah, it's my other class, because this class said you couldn't see the cursor. In the other class that I taught people, I was assuming they couldn't see the cursor, and then they told me they could. Okay, so that makes it, I'm not sure how to point to things. But anyway, so I think we covered this. The main points here, if you see the overall balance, is the accumulation of the current and capital and financial accounts. And the overall balance, what matters is below the line. And the main thing is the change in net foreign assets for most countries. I picked Haiti in particular because they had an IMF program. And so I think we went over all this. I'm just trying to see if I can get everything in my screen that I need at the same time. So it takes me a moment to figure out. Okay, sorry, is the screen still being shared? Scott, you're the only one I can see, so yeah, okay. All right, so I'm gonna skip over some of this quickly because we went over it. And yeah, I kind of remember talking about errors and omissions. So my notes were that we hadn't gone over this, but I thought we did. Let's go again. You remember this? The interpretations of errors and omissions. I thought, okay, so somehow must have typed in the wrong number. So maybe this is where we were. All right, so what I just wanted to talk about, we've gone over different concepts of different external sector identities. And I just wanted to talk about how you understand each of these. And again, if I've already done this, for some reason my memory isn't crystal clear of 2 weeks ago. It was like 2 years ago, actually. So if we've gone over this already, I can skip over it. But these are the main concepts we got over. Trade balance, right? So GDP minus absorption, or just, it's exports minus imports of goods and services. The current account balance expands to include, you'll hopefully remember, actually people did this well on the exam. It includes primary income account and secondary income account. So the income that residents earn abroad, as well as the transfers from abroad to residents. And so that's the gross national disposable income concept, and subtracting off domestic consumption and investment gives you the current account balance. And then the current account balance is also, as we proved, equivalent to saving minus investment. And so these identities we actually proved in the most of them actually in the real sector lecture, but bringing them back here. And then the overall balance, which is what we've just introduced. And when I say just, it was 2 weeks ago, but that's essentially putting almost everything above the line except for the change in central bank reserves, and then any exceptional financing, which includes borrowing from the IMF and also repaying the IMF. So what's the interpretation of each of these? So if you think of the trade balance, what causes a country to export or import? Well, it's a question of whether the country is just actually producing enough goods and services to meet the demand that residents have for that. So in other words, is the country absorbing, or absorption is consumption plus investment, including of foreign goods, and GDP is what the country produces. So
Professor?
Yes.
Sorry, can I ask you to stop sharing your screen and then re-share it, and then try re-sharing it? There's this weird blue margin on it.
Oh, is there?
Yeah, does everyone else have that, or is that just me?
I'm seeing it too.
Okay.
Oh, okay. Thanks, Rhino. All right, let me stop share. Actually, could have paused share. And do you see it now? Is it?
Yep. Yeah, that's much better. Thank you.
Oh, okay. Rebooting solves everything somehow, or the equivalent thereof. All right, so yeah, so the trade balance just says, does the country produce enough for the amount that people want to buy, in effect? And if it produces more than enough, then the additional amount gets exported. And if it doesn't produce enough, then the country has to import that amount. Oh, by the way, that does remind me, there was one question on the exam. Basically, I kind of got to the point where when I was constructing the exam, I had everything, and then I thought, oh, we could use one more question. So I had a question at the very end about how the pandemic would affect internal and external balance of your country. And to be honest, I hadn't given much thought to how people might answer that. So and that's the one question I still have to grade. So I'm looking forward to reading that. I will go pretty easy on that because some of that would have been much easier to answer, after talking about what we're talking about now. So that was kind of almost a giveaway question where as long as you said something reasonable, I'll give you full credit. But some of the stuff, thinking about the interpretation of these balance of payments balances certainly would have helped you to answer that question. So it was arguably a little bit unfair of me to ask that question, but thought it was nice to have at least one question about what's going on right now. So anyway, so current account balance is not just about what the country produces, but about the disposable income available to countries or residents of a country, which includes, as we've said many times, the income that they earn from production in another country. In other words, the primary income balance, as well as the gifts received from abroad. So that's the total income available. So if you look at the current account balance, the question it's really asking is the income that's available to residents, not just what is produced in the country, but the total income available to residents, is that enough to meet their needs for absorption? In other words, consumption and investment. And if the disposable income is more than enough, then they're running a current account balance. And if it's not enough, then they're running a current account deficit. So the interpretation of current account balance is saving minus investment. Just is the country a net saver? And so if you look at the previous question, but then you subtract investment off of each side, what you're seeing is the country's income. Out of the country's income, does it save enough? In other words, does it refrain from consumption enough to finance the investment that the country wants to undertake? And again, if it saves more than enough, then it runs a current account surplus. So it's a country like China or Germany. And if it doesn't save enough to fund its investment, then it's a current account deficit country. And that's actually an important point. I think I made this before, but the reason economists don't equate current account deficits with being in a bad position is because countries will often benefit from undertaking a lot of investment. And if they can't save enough resources to do their own investment, it may be optimal for them to get resources from the rest of the world for that investment, as long as that investment is productive and allows the country to increase its welfare in the future. So again, I mean, I kind of hate to keep picking on, I don't really hate to keep picking on Trump. I'll pick on him again. He has this interpretation that the United States is running a current account deficit, and that must be a bad thing. It may be a bad thing, but it's not necessarily a bad thing, because it may be that foreigners think investment is more productive in the United States, so they benefit from financing that investment, and Americans may benefit as well if the investment is indeed more productive in the United States than it would be elsewhere. Now, there is a general idea that countries that have less capital should actually have higher productivity of investment. So if you think of poorer countries, generally much more labor intensive, and industrial countries are much more capital intensive, there's an argument to be said that countries that are poor and don't have enough capital should have a higher productivity of capital, and therefore the flows should go from rich countries to poor countries. In practice, that hasn't often been the case. In fact, the United States is, typically the largest, in magnitude, dollar magnitude terms, the largest current account the largest current account deficit country in the world. So there is something that is a little counterintuitive, and maybe even it's not a good thing, that the rest of the world is financing a lot of investment in the United States, which of course is already one of the wealthiest countries in the world. And then the overall balance, so the current account balance is about income generated by the residents, including income generated by domestic production, but also, in a sense, by foreign production. The overall balance broadens that equation out literally to also consider, is the country able to attract enough capital? In other words, is it able to borrow enough, and is it able to attract enough direct investment to finance its current account deficit if it has a current account deficit? And if the overall balance is positive, it means the country is able to attract more than enough capital to finance that current account deficit, if it has a current account deficit. If the overall balance is negative, then what it means is the country is doing one of two things, or quite likely both. It's losing central bank reserves, which are there to preserve financial stability and to help finance, when necessary, overall balance of payments deficits. But in general, U.S. central bank doesn't want to be losing reserves. And if it's losing a lot of reserves and that doesn't appear to be sustainable, then it's likely that the country is going to have to resort to extraordinary finance, which means usually pretty much one of two things. Either they're going to the IMF to borrow, which is a sign that you are not in external balance if you have to borrow from the IMF, or an even more extreme case where sometimes accompanies an IMF program is that the country has to restructure its debt. So, in other words, it can't repay the finance it has been able to attract in the past. So it's been able to borrow in the past to fund its overall balance, its current account balance, and now it can't fully repay that, so it has to restructure its debt, and that's what extraordinary finance means. So if either of those two things happens, if either the central bank is losing reserves or the country has to restructure its debt, or both, that's certainly a potential sign of trouble. Occasional overall balance deficits have to be measured against the amount of central bank reserves that are left. So a country that has very strong central bank reserves and loses some of it shouldn't really matter. China's central bank reserves, I think, at one point were over 3 trillion, and they ran fairly substantial overall balance deficits for a while, but we still have over, I don't know if they said they had over 3 trillion in reserves. I don't know if they said billion or trillion, but it's 3 trillion. Now they still have, last I checked, over $2 trillion of reserves, which is still more than enough. So if a country already has lots of central bank reserves and overall balance, an overall deficit in the may not be that much concern. All right, so just one link between the IIP and the BOP. And I mentioned Switzerland earlier, and I just quoted this, which I can't remember where it came from. It says, movements in investment income were mainly determined by earnings from direct investment. Since under direct investment, stocks of foreign assets were considerably higher than those of foreign liabilities, receipts were generally higher than expenses. So, and I sort of had me deja vu. Did we go over this? I'm still looking at, or is this new? Maybe I'm just remembering from talking in the past. This looks new. I can only see Scott and Gerardo, so I don't know.
I don't remember it. You don't remember?
Okay, that's good. That means I'm not. Okay, I can see Gene as well, but I have to scroll through. Okay, so so the idea here is usually if a country has a positive net IIP, in other words, they're a creditor to the rest of the world, just like anybody that is has a lot of assets, they're also going to have a lot of income from those assets. So there's this cycle, and I guess you can't see my cursor, but the higher your net IIP, the more positive your net asset balance, the more primary income you're going to earn, and that's going to improve the current account. And improving the current account allows you to acquire more assets, allows you to have capital outflows, and so that's a positive cycle. So I think I mentioned Norway. I tend to think of Norway because Norway has a very substantial oil fund, which owns lots of assets abroad, and it also earns a lot of income on those, and that helps it run a current account surplus and acquire more assets. So Norway is getting very wealthy. So that's what these bullet points say. The more improved the current account, the more net assets earned by, I should say the more net income earned by the country, and therefore it can acquire assets abroad and improve its IIP. And so it's just a typical law of the world. If you're rich, you get richer, and if you're in debt, you get, and I made a word, indebteder, which isn't actually a word. So, okay, and sorry, there's a footnote there. The big exception there is the United States. The United States actually has the largest negative net IIP. In other words, the U.S. has far more external liabilities, external assets, and yet it has a positive primary income account. And that seems very counterintuitive. But the reason is the U.S. liabilities are, to a significant extent, very low return liabilities. So especially U.S. Treasury bonds issued by the U.S. government. And then a lot of foreigners invest in bonds that come out of the U.S.'s housing program. So the U.S. has two big agencies which issue debt to essentially fund Americans buying cheaper houses, Fannie Mae and Freddie Mac. And those bonds also pay very low returns. And so, yes, the U.S. has a lot of liabilities, but it pays very low yields on those liabilities, and its assets tend to be very high returning. So the U.S. has this odd situation of, despite being a very large net, despite having a very large net liability to the rest of the world, its investment income is actually positive. That's something you should be aware of. Okay, so I want to, this is the last section of this lecture. Let me try my last sip of coffee. And this is the question which is critical if you're in the IMF and you look at a country and let's say it's running a current account deficit, as many countries are. And the question is, can it sustainably finance those deficits? And remember what I said just a few minutes ago, current account deficit, if you can easily finance it, and as long as the investment that's as long as what's being invested is in high productivity investments, current account deficit isn't necessarily a bad thing, quite likely a good thing. But the question is the financing to finance that current account deficit is sustainable? So this is basically my own framework. So, but I'm going to ask 5 questions. This comes out of the work that I did. I worked for quite a long time on financial stability and worked on some internal exercises at the IMF where we were essentially looking at every country in the world and looking at whether or not they were likely to be a problem case that might at some point come to the IMF for borrowing. So 5 questions in hopefully a logical order. First thing you have to ask is, how vulnerable is a country to some sort of balance of payment shock that could significantly worsen its current account? And that really goes, for instance, to the question that I mentioned on the midterm, the question of how does the pandemic affect whichever country you want to focus on. In terms of globally, what's the effect of the pandemic on the global current account balance? I don't know if anyone wants to answer that. Okay, so no one volunteering. It's got to be 0 because globally the current account balance is supposed to be 0. Statistically, by the way, it's not, because there's statistical discrepancies, but for every country that has a current account surplus, or for every dollar of current account surplus, there's got to be a counterpart deficit somewhere else in the world. So it can't be the case that this pandemic is bad for every country's external sustainability. Some countries are going to have their current account balance improved, and I hate to use the word improved, having said that a deficit isn't necessarily a bad thing. But that was what I was getting at, is when I asked that question on the midterm, tell me, think about your country or whatever country you wanted to look at and tell me how you think the pandemic might affect its external balance. So I'm looking forward to seeing what people said. So anyway, how vulnerable is a country to an exogenous balance of payment shock? The pandemic is likely a big shock for most countries, but in which direction it goes is not necessarily clear. So second question is, the first question goes to how, can the financing need change very suddenly? Can you all of a sudden go from a small current account deficit or even a current account surplus to all of a sudden a large current account deficit? Which, by the way, oil exporting countries are going through now. Oil has gone from like $60 a barrel to $20 a barrel. So if you're a Venezuela or an Ecuador or a Russia that relies heavily on oil exports, you've just had a huge exogenous balance of payment shock. Actually, that was one of the midterm questions as well. So your ability to attract financing is going to depend in large part on whether you can repay your existing stock of obligations. So you have to look at how big is the country's existing stock of financial obligations. If it's already highly in debt, it's going to be more difficult to borrow, just as it would be for an individual. If it has borrowed very little, it will be easier to borrow some more. A third question to go to then is how stable are the external sources of financing? How reliable are they? So countries that rely on sources of financing that tend not to be disrupted are going to be in better shape if they have a shock than a country that relies on a very volatile form of financing. We'll touch on that. So we've been talking about the liability side. What about the asset side? So it's not only what is the country's stock of external liabilities, it's what is its stock of external assets. And so this is particularly relevant if a country's financing is cut from the rest of the world, is cut off. Does it have a stock of assets that it can rely upon? Just like you have a stock of toilet paper that you can rely upon if the external ability to get toilet paper is hampered, which it currently is. So one of the things I guess that's not really a liquid asset, but anyway, hopefully you get the idea there. And then the last question is, so the first question is about how vulnerable are you. The second, third, and fourth questions are about the ability to have access to finance. And then the last question is, if you don't have access to finance, how easy is it to reduce your need for finance? In other words, how easy is it to adjust your current account balance, and how painful is it to adjust your current account balance? The bottom line is, if you don't get the financing, you as a country will have to adjust your current account deficit downwards. But there's different ways to do it. There's ways to do it that are less painful, and then there's very painful ways to do it, which is that people simply can't import what they need to import because they don't have the financing to do so. All right, so let's go over these one at a time. So the first question, and again, this is just kind of not my own framework, but the framework kind of codified from the work I'd done for many years at the IMF. So how vulnerable is a country? So I think there's three main questions you want to ask. How open is an economy? How concentrated is the economy's export and import base? And then how volatile are the terms of trade? So in terms of how open an economy is, clearly the more a country depends on trade, the more vulnerable it is to a cutoff of trade. So I actually looked up the two most open countries in the world. This was actually part of the homework assignment, by the way, and I do apologize because I'd hoped to be done with this lecture for that, but I think you could sort of work your way through the homework, even though we hadn't covered quite all of this. So one of the things I asked you to do was look up openness of, I guess, of your country, or at least a country you chose. So the way openness is measured is very simple. You just take exports plus imports, add them up, divide them by a country's GDP, and that's usually the measure that is used to say how open a country is. In other words, how reliant is it on trade. So countries that are highly open, that can often be an advantageous thing because trade, as we know from the time of Ricardo, has benefits if a country uses its comparative advantage. But also, if you're highly dependent on trade, you may be vulnerable to a sudden shock that contracts that trade. So on that openness measure that I was talking about, the two most open countries are Singapore and Luxembourg. You won't be surprised to realize, okay, those are small countries. They're actually countries that are wealthy countries, so they can afford to import a lot, but they're small enough so they can't manufacture a lot of their own goods and services. And they're also physically small, so they have fairly open borders. So all those things mean that they're very open. So small countries tend to be more open just because they have to rely on trade. They can't produce everything themselves. Not that many countries actually produce cars, for instance. So most of the 189, I think it is, member countries, the IMF, don't have their own auto manufacturing capacity. Most of them have to import cars from the US or Canada or Japan. So small countries may be vulnerable to that. Related to that, how concentrated is an economy's import and export base? So usually we think of this in terms of how concentrated are a country's exports. So if a country relies very heavily on one particular thing that it exports, it doesn't have the benefits of diversification of its export base. And if that one thing that they export all of a sudden isn't in demand or the price falls a lot, they may be vulnerable to a serious export shock. We tend not to think as much about the vulnerability of concentration of imports, but that's another case where this pandemic is raising interesting questions. One of the things that people are talking about now is the U.S. relies a lot on China for imported parts, for instance. And so as the supply chain is being disrupted, we're finding the United States is potentially vulnerable to a cutoff of an ability to import from China, at least as much as before. But anyway, the more diversified your export base, the more diversified your sources of imports, the less vulnerable you are to a shock. And then the last thing, and this is kind of related to that, the terms of trade. Again, this is something that I think I asked you about in the homework. I can't remember for sure. But it's just simple. You just take the average export price divided by the average import price. So the terms of trade going up makes you wealthier. The terms of trade going down makes you poorer. And some countries are highly vulnerable to the terms of trade because they export things that are very volatile in prices. So again, commodity exporters, and particularly oil exporters, have very volatile terms of trade because the price of oil, as we've seen, can move quite a lot in a short amount of time. The oil price has fallen by 2/3 in a matter of a week or two. So Venezuela, I think, is the country with the highest concentration of exports in petroleum. Something like 90% of its exports are in petroleum. So the country's been suffering enormously even before this. So what they're going through now is unimaginable to me, but their revenues will have been seriously cut off because they've got highly concentrated exports, but highly concentrated exports in a commodity that has a very volatile price. If your exports are mostly manufactured exports, the prices don't tend to vary as much, so you're better off than if you were a commodity exporter. So those are the three things to consider in terms of a country being vulnerable to a balance of payment shock. In other words, something that can worsen a current account deficit. Footnote there, by the way, this is certainly not something you need to know about, but there's a guy called Ricardo Hausmann, who's an economist at, I think, Harvard, if I remember. He wrote a paper that a lot of new papers have been written about, which is a way to measure a country's diversification. It's a bit more sophisticated than previous approaches, but maybe a couple of you are aware of that, but I won't go into it. All right, so that's the vulnerability to a shock. All right, what about measuring the country's stock of liabilities? As I said, the higher the liabilities you have, the more difficult it is going to be able to borrow more. So I've got three metrics listed here. The most common metric you see is going to be the second one, which is the external debt to GDP ratio. And I noted on the right whether that's a stock or a flow. So external debt is a stock. Doesn't have a time dimension. You can say at a given moment, what is a country's external debt? GDP, of course, is a flow. It's how much production a country can crank out in a given period of time. So the external debt to GDP ratio, in a sense, tells you how many years of output do you need to be able to, if you were to pay off all your debt. So typical metric used to be 60%. So in other words, it would take you 6/10 of a year, whatever that is, and I guess about 6 or 7 months of output to pay off all your debt. If you were able to dedicate all your output for 7 months to paying off your external debt, you could turn your external debt to zero in that amount of time. These days, because interest rates are so low, people will think that a lot of countries can handle somewhat higher external debt to GDP ratios. I'm sorry, I should say the norm was the debt to GDP ratio should be 60%, but extra for some countries, a lot of the debt will be external. The problem with using GDP as a metric is a lot of GDP can't be converted into foreign exchange with which to repay debt. So you might want to look at the third measure there, which is external debt to exports. So that would be how many years of export receipts would you need before you could pay off your external debt. You may want to look, instead of just the stock of external debt, you may want to look at how much debt service you have to pay each year. So debt service is a flow. It's the repayment of principal plus the interest that you have to pay on your stock of debt. So you can also look at that as a ratio to either GDP or exports. And debt service to exports probably makes a lot of sense. It's how much does a country generate in foreign exchange earnings? That's the exports. And debt service is how much does the country have to use those foreign exchange earnings to repay its debt. So you don't want all your export earnings to go towards paying debt service. So you'd certainly like that ratio to be below 100%. And so I'm not doing these in order. The first one, the net IIP over GDP. You might say, well, a country has a lot of external debt, but it also has a lot of external assets. And if a country has a lot of external assets, you shouldn't worry as much about its external liabilities because it can use those assets to repay the debt. So it's not just looking at the flow of output or of exports that you can use to service the debt. It's looking at also your existing stock of assets, right? So net IIP is those external assets divided by minus the next external liabilities. So the case that most people would be thinking of here would be Japan, where they have significant liabilities. Although I don't think they're necessarily significant external liabilities, but they also have a lot of foreign assets. In particular, they have a lot of reserves. So you wouldn't worry as much about Japan if you look at their net IIP to GDP ratio as you would if you just look at their debt to GDP or external debt to GDP ratio. All right, so there's a bunch of different ways to look at a country's liabilities, and each one tells you something different. And so you may want to consider one or the other to assess a country's vulnerability. All right, so stability of financing sources. I think I talked about this already, but generally countries that rely on direct investment are less vulnerable than countries that rely on portfolio investment. Direct investment, you will recall, means that foreigners have some sort of control or influence on the company that they're investing in. And so if you are investing in a company because it's your business idea or it's actually you own the business, you're not going to cut and run at the first sign of trouble. You know, if I owned a factory in Mexico or something, I'm not going to all of a sudden sell that factory just because of some news item. Right? I'm somewhat dedicated to managing that enterprise and trying to make it grow and so on. So direct investment is usually a relatively stable form of financing. Portfolio flows are different. Portfolio flows, whether it be buying foreign bonds or buying foreign stocks, you have no particular interest in running the corporation or running the government if you own government bonds. So you are just, if you're a portfolio investor, you're primarily thinking of where's the highest return I can get now or the best return for the risk that I'm taking. And so portfolio flows can be very volatile and do react all the time to headlines. So, you know, you hear something about a policy position that you don't like, or you hear that maybe a company is being sued and you sell their stock immediately. So portfolio flows are quite volatile, and some countries rely heavily on them. The countries that come to mind, Brazil, which I showed there, Turkey also relies heavily on portfolio flows, and I think South Africa is another one, and there's a couple of others. And so if you rely on stable sources of financing and you face an external shock, you probably aren't going to lose that financing immediately. But if you are relying on portfolio flows and there's an external shock, then you can see a very large outflow of capital in a short amount of time. So that's another thing to consider. And indeed, Brazil and Turkey and South Africa, and there's probably a couple others, are countries that spring to my mind when I think about if there's some sort of sudden change in sentiment for investors in emerging markets. Those are the countries that are often viewed as vulnerable, and they also have large current account deficits. All right, so, okay, here's the bullet point that just says what I just said. So the other thing you would look at is debt financing versus equity financing. So if foreigners are buying bonds, the risk is with the debtor because a bond is an obligation to repay. And if the debtor can't repay, then the bond has to default. Equity financing means that foreigners are actually buying into the ownership of companies. And if the company starts to perform poorly, the equity holder loses some of the value of its shares. The dividends may be cut. But the point of equity financing is precisely that the equity holder, the shareholders, agree that they will take the risk of poor performance by the company in return for the hope that the company does well, and then they'll get a larger share of the profits. They'll get dividends will be raised, and the price of the shares will rise. Whereas if you own a bond, you're owed whatever the coupon on the bond is, but nothing more. And if a company happens to do better than expected, the bondholder doesn't benefit, except in the sense that default is less likely. All right. So, all right. Third question: the sustainability of debt finance. So, some useful metrics: average maturity. So, when a country is really skating on thin ice, in other words, they're looking highly vulnerable because there's been some balance payment shock. It may be difficult for them to attract new financing. They may not have a large stock of assets. People will start looking at some of these metrics. So average maturity says how long does a country have to repay its debt. So and you may even look at the country's actual debt profile, where you say, let's not just look at average maturity. Let's look at how much they owe for the next quarter. Do they have any large repayments coming up? And when a country is getting to the point where investors are worried about default, they will start looking very specifically at what repayments does that country have coming up, and is there a specific payment that may be difficult for them to repay, and if they can't, then there's a default. So average maturity is kind of a measure of that. The longer a country has to repay its debt, the less worrisome any given debt to GDP ratio is. So this is, how old is this? March 2018. So my favorite chart maker in the world is a guy called Torsten Slok. If you look at the bottom of this chart, you can see his name there. He works for Deutsche Bank and used to work at the IMF. And he specializes in all kinds of chart packs. He sends out these chart packs with hundreds of charts of all kinds of things. So I sometimes look at his charts and find something that I can use here. So this is a couple of years ago. I don't know if he's done this more recently, but just looking at the average maturity of outstanding government debt. And so you can see the U.S. relies a lot on very short-term debt. You see the average maturity there is about 5 years. So typical average maturity is 5 to 9 years. So you're just taking a weighted average of when the repayments have to be made and seeing what that is in terms of how many years in the future, on average, those repayments are. UK has unusually high average maturity. I'm not sure why that is, except I do know that they actually issue some what are called consols, which are literally don't have a maturity, an expiration date. They just promise to pay interest forever, and you never get repaid the principal. So that's actually like owning equity in a country. But I don't think those consols that they issue are large enough to explain why they have such a long average maturity of their debt. But anyway, you get the idea. The longer the average maturity, the less vulnerable you are, because the more you can spread out your payments. So you can take a look at footnote later. So another thing to look at is the rollover rate. So this is a question of as money comes due, as you have to repay your bonds or your loans, are you able to borrow again? So gross disbursements means how much are lenders lending to you, and amortization is how much do you have to repay those debts. And you'd like that to be over 100%, over 1. So you'd like more money coming into the country in terms of financing than is going out in terms of repaying that financing. So if you get rollover rates below 1 or well below 1, and it's sustained for a period of time, that's telling you that the rest of the world is becoming more and more reluctant to help you repay your debt. They're rethinking investing in your country. So that's something to look at. And then the last thing, which is probably the most common thing to look at, is something called a risk spread. And this is something that if you have a Bloomberg machine, you can look at a country's risk spread or a company's risk spread at any given moment. And it's simply how much extra yield does a country or a company need to pay on its debt compared to a safe borrower. So if you're borrowing in dollars, let's say you've got a 5-year bond and it's yielding 6%. In other words, that's how much the debtor has to pay to be able to borrow, and compare that to what the U.S. pays on a 5-year bond, which is right now, it's under 1%, I think. So that would be a risk spread of 5 percentage points, usually expressed in basis points. So it's 500. The basis point is 0.01%. So the higher your risk spread is, the more the rest of the world is charging you to borrow, and they're charging you more because they perceive you to be riskier. And as those risk spreads increase, that in itself is a problem because you're paying more for your borrowing, at least for new borrowing. So risk spread, also called a credit spread. So you may have seen those, or you may be familiar with those. All right. So this is the fourth thing that I want to look at, which is the availability of liquid assets. So we've looked at the liabilities and how vulnerable you are to a shock, and various metrics about your liabilities. So if you look at the asset side, that matters because if a country can't borrow, then it's going to need to start drawing down its assets. Or there may be situations where a country could borrow, but its risk spread has increased a lot and it thinks that's temporary. So rather than pay very high interest rates on new bonds or new loans, it will wait it out and it will use its assets until it becomes cheaper to borrow. So what are the stocks of assets? And this goes to something called reserve adequacy metrics. These are things that if you work at the IMF, and hopefully some of you will someday, these are standard measures that are usually reported in every country report. How much foreign exchange does the central bank have? And there are different ways to think about it. The traditional way to think about it was in terms of months of imports. So the idea was if a country has difficulty attracting capital inflows to finance its current account deficit, how much can it use its central bank reserves? Remember, those are below the line. How long can the country kind of last at its current rate of importing before it runs out of reserves? And the standard used to be, and probably still is, that as long as you have enough reserves to import at least 3 months worth of goods and services, that's kind of considered an adequate amount of reserves. Just like you might say, if you had cash in the bank and it was enough to last you for 3 months of your own consumption, purposes, you might feel comfortable. So if you lost your job and your income is cut off, you still have 3 months of money in the bank to pay for your needs over the next 3 months. Now, one of the things that I think it came out of the Asian crisis more than anything else is economists started to realize, well, it's not only that reserves might be used to finance a current account deficit, it might be used to repay debt. And so you started looking at central bank reserves relative to the amount of debt that they had to repay, and specifically short-term debt. When you hear short-term versus long-term debt, that typically the dividing line is 1 year or less. So whatever debt you owe in the next year is short-term debt, and debt that you owe after 1 year is long-term debt. Sometimes you see medium and long-term debt, but short-term debt for sure is debt you have for less than 1 year. So if you look at the central bank reserves and say, is it enough to repay my debt that I owe, my debt repayments that I owe for the next year? If I do have enough, then I'm comfortable. If I have less, if I only have enough to repay my short-term debts for the next few months, that might be a little bit uncomfortable. So that's looking essentially at a measure of assets relative to liabilities. Right? So that's going to be a stock divided by a stock measure. And then the last thing that I have here, central bank reserves to borrow money. In extreme circumstances, residents of a country may worry in particular about a devaluation, or they may worry, let's say, about expropriation, that the government will just steal their assets. So there are situations where residents of a country want to pull their money out of the country and invest somewhere else. Or they may just be worried that they may be in a country where they think the stock market will fall. They have a lot of money in that stock market. Maybe they don't feel it's safe to put money in the country's banks, so they want to buy something like U.S. Treasury bonds, or they put their money in Swiss bank accounts because those are perceived to be safer. So that's called capital flight. And if you're worried about capital flight, how much capital flight can there be? Well, in principle, one way to think about it is how much money is there in the country. In extreme case, if all of that money was taken out of the domestic financial system and put in a foreign financial system, well, that would be it's not imaginable that you lose the entire amount, but typical range, and this is a very broad range because people don't really have a handle on how bad capital flight can be, but you see there 5 to 20% is considered an acceptable range. So if you had reserves that were less than 5% of broad money, it's not that hard to imagine people taking, 5% of their money out of the country in capital flight and trying to put it in the US or wherever they perceive it to be safe. And if that capital flight completely drains the central bank reserves, then that's a cause for worry. So countries that have capital flight risk, you'd want to look at central bank reserves to borrow money. So I think it's, and then the other question you might ask is, if you don't currently have foreign exchange, can you get access to foreign exchange by borrowing from the IMF? So you may look at how much could a country borrow from the IMF if it had to go to the IMF. And the borrowing from the IMF is, or at least is supposed to be, related to a country's quota in the IMF. So for years, the limit was that a country could borrow up to 3 times its quota in the IMF. During the Asian financial crisis, those limits were vastly expanded. So countries like Korea borrowed something like over 20 times their quota in the IMF. Every time that happens, every time these what are called access limits are expanded, afterwards there's some regret, and the IMF board starts saying, oh, we shouldn't be doing that again. It causes moral hazard if countries know they can borrow huge amounts. Also accusations that it's very unfair. So that particularly happened in the case of Greece, where, and I can't remember how much Greece borrowed, but it was more, I think, in relation to its quota than any country had ever borrowed. So there were accusations of the IMF is favoring a European country. They wouldn't lend that much to an African country or an Asian country. And so the huge program that was given to Greece has caused a rethink of those limits. But anyway, the typical way to kind of look at how much a country could borrow from the IMF is to look at their quota, consider how much of that quota they can borrow, and that would tell you about their access to IMF financing. So in other words, sort of borrowed foreign exchange reserves. And typically, by the way, that's what happens when the IMF lends to a country. What it's doing is it's lending a so-called usable currency to the country's central bank. Usable currency being a country that can be used internationally. It's a bit more complicated than that, but not worth getting into. All right, and so, one last point. So we're thinking of liquid assets. So central bank reserves are held in things like bank deposits, government bonds that are easy to sell. A country may, for either emergency purposes or maybe just because it doesn't think it should be owning certain assets, it may have assets that it can sell. It may be buildings or things like that, but it's often a company that it owns, and it may sell it, and it may sell it to foreigners. That's, as you can imagine, usually a controversial thing to sell a government-owned company to foreigners. So I think in Mexico, which has Pemex, which is a big state-owned oil company, it not only wouldn't sell Pemex to foreigners for years, it wouldn't allow foreign investment in its oil sector, and that changed a few years ago. But countries tend to be reluctant to sell state-owned enterprises to foreigners, but if they have to, that may be another way to convert a relatively illiquid asset, a big company, into a liquid asset, in other words, some sort of cash. All right. So, and then the last thing to look at, and this is going to be, I think, the remainder of this lecture, is pretty much about, suppose you have a lot of liabilities. You have a big external shock that makes it more difficult to repay those liabilities because you're not, your current account worsens and you're not able to earn the money to repay the liabilities, and you're running out of assets. You borrow from the IMF, but you can't borrow enough, so you still need to adjust your current account. And indeed, the IMF in an IMF program is typically going to ask you to undertake policies to try to reduce the current account deficit if that's the reason you're borrowing. So there'll be some mix of financing from the IMF, but also the IMF advising you to adjust your economy so that you don't run as large a current account deficit and don't need to borrow as much financing. So I'm going to look now in the next few slides about how easy it is to adjust your external balance, your current account deficit. So this should be familiar from international monetary theory. And indeed, when I started teaching international monetary theory, I took some of these slides that I created for this and brought them over to my international monetary theory lectures. But if this is a review, hopefully it'll be helpful. And if it's boring, most of you aren't on camera, so I won't know if you leave for a minute anyway. So the first thing we have to look at is the real exchange rate. So the real exchange rate is typically what the IMF would look at to measure a competitiveness of a country. In other words, how affordable are the country's exports and how expensive are the country's imports. So the advice for a country running into a large current account deficit may be that you need to depreciate your real exchange rate, particularly if it's a country that has a fixed exchange rate. If it faces a shock that looks like it's going to go on for a long time and you don't want to just keep borrowing to finance that shock, you should try to adjust the current account. And so adjusting your competitiveness is probably the most effective way to do that. All right, so the real exchange rate is that measure of competitiveness, and it's just the exchange rate, E here, and this is units of foreign currency per units of domestic currency, so that's usually the way economists cite it, but just be careful about which way it's being cited. So units of foreign currency per domestic currency, the higher that is, the weaker your currency is. In other words, if it takes, oh, sorry, it's the other way around, is it? Yeah, okay, I've done this the right way. So
I think it should say if the former, not if the latter, at the very end.
yeah. Okay.
The way you have it here is right. Up is up.
Yeah. Okay. So units of foreign currency for domestic currency, and then you look at just by the relative price levels, right? So the higher the price level is in your country, the more appreciated the currency is. Yeah. So I'm expressing the exchange rate the opposite of the way I typically would do it. So the more units of foreign currency per domestic currency. So if E goes up, your nominal exchange rate is appreciating. If P goes up, that's the domestic price level. If that goes up, then also your real exchange rate is appreciating. So either E going up or P going up makes your exports more expensive and makes you less competitive. On the other hand, if the foreign price level goes up, that makes your exports relatively more competitive. So P star going up, in other words, the real exchange rate going down, represents a real depreciation for your country, meaning it becoming more competitive. I would typically flip that. I'm not sure why I did it this way. Maybe I was just following the IMF presentation. Anyway, so that's the real exchange rate. It's a measure of competitiveness. So another way to, yeah, okay. So I forgot this footnote. So I'm defining the real exchange rate. So higher is an appreciation. Typically in academic applications, it's going to be the other way around. Higher real exchange rate is a more depreciated exchange rate. All right, so real exchange rate is going to tell you how much a foreigner pays for domestically produced goods versus foreign produced goods. So you may be familiar with the Economist's Big Mac Index, in which they try to see how much Big Macs cost around the world, adjust those for the exchange rate, and that tells them, at least for the Big Mac, whether a country is sort of overappreciated or underappreciated relative to other countries. So an example there, if a Big Mac is $4 in the US, I haven't bought one in a while, but I think that's about what they are, then say €3 in France, where is it cheaper? Well, the obvious point, you have to figure out the exchange rate to tell whether it's cheaper. And so if the euro-dollar exchange rate is higher than 0.75, it's more expensive in the US. So in other words, the weaker the euro gets, the more euros you have to use to pay a dollar, the more expensive it is for a European to buy a Big Mac in the US. All right, so that should be familiar. So the things that can make the real exchange rate appreciate is either the nominal exchange rate appreciates, right? So that's E rising here, again, the way of defining it, or domestic prices rising faster than foreign prices. So looking at relative inflation rates is going to tell you something about whether a country's exchange rate is appreciating. So if a country has very high inflation and a fixed exchange rate, its real exchange rate is appreciating, and that's going to make it harder and harder to sell exports abroad. And we'll look at the condition in just a minute. You may already know it, but the condition that will tell you whether that will make the current account more in deficit. So typically we think an appreciating real exchange rate is going to make a country's current account deficit larger. Then if you've got both the nominal exchange rate adjusting and relative price levels change, you've got to look at the product of the two. So some countries actually will try to compensate for higher inflation by depreciating the nominal exchange rate, something called a crawling peg, which was much in fashion in Latin America in the 1980s and to some extent in the 1990s. And the idea was Latin American countries knew their inflation rates were higher than their trading partners' inflation rates, so certainly higher than US inflation. So they would try to compensate for that by depreciating their exchange rate on a pre-approved schedule. So that's what a crawling peg is. Right. So, all right. So I've said this already. A real exchange rate appreciation makes domestic goods less competitive relative to foreign goods. The IMF. So I said that the IMF looks at real exchange rates to determine whether a country is competitive. Well, then you might say, well, which exchange rate do you look at? Right? Because you could look at, let's say, a bilateral exchange rate with the U.S., but 100% of your trade may not be with the U.S. Maybe 60% of your trade is with the U.S. and 20% is with Europe and 10% is with Japan and 10% is with different Latin American countries. So what you want to do is look at a weighted average exchange rate. So a real effective exchange rate, you're just adding the word effective in there, that's just an index where you are weighting the average real exchange rate and usually weighting it by trade shares. So the real effective exchange rate is one of the standard measures of whether a country is competitive, and you're particularly looking to see is the REER, is it rising or is it falling? Is it appreciating or is it depreciating? That's much more useful than just looking at a bilateral exchange rate. So I'm just adjusting something on the screen here. Oops, just made something disappear that I was trying to look at. All right, so other things equal, and we'll talk about that in a minute. Real effective exchange rate appreciation increases a country's exports and decreases exports, so that will worsen its trade balance and therefore most likely its current account balance. A real exchange rate depreciation should help increase the trade balance, right? And if you are able to adjust your trade balance, then you can do some combination of using less foreign assets, so you hopefully lose your foreign exchange reserve slowly, and you don't need to borrow as much. All right. So when you talk about, there's a concept of expenditure switching policies, and an expenditure switching policies means you are trying to switch expenditure from foreign countries to your own country. So when you hear of an expenditure switching policy, it really refers to depreciating the real effective exchange rate. And in doing so, you make your goods more attractive to foreigners because your exports are cheaper, but you're also making your domestic production more attractive to domestic residents, because now when they're considering whether to buy a domestic good or a foreign good, a real depreciation makes foreign goods relatively more expensive. So expenditure switching means you're trying to switch the expenditure of both domestic residents and foreign residents to switch from buying foreign goods to buying domestic goods. All right, so that's expenditure switching, and we'll contrast that in a minute with the other type of policy. All right, so a country may then try to depreciate its exchange rate to achieve a real effective depreciation, but a country doesn't directly control the real exchange rate, it just directly controls the nominal exchange rate. When I say directly controls, that's assuming it's got some sort of fixed exchange rate or is maybe adjusting the exchange rate over time. So if it tries to depreciate its nominal exchange rate over which it has control, the question is, does that actually translate into a real depreciation? The risk is you depreciate your nominal exchange rate, and all you do is set off inflation in your own country, and you haven't depreciated the real effective exchange rate, and you made a lot of domestic residents angry because they don't like inflation. So it's possible that you could depreciate your currency and set off an inflation that actually even more than offsets the nominal depreciation and makes you less competitive. And I know I worked in Trinidad and Tobago. I don't think it's a secret. We were at some point recommending a depreciation. We hinted at that pretty strongly in our staff report. And that was the argument they made. They said, everything's imported. If we depreciate our nominal exchange rate, businesses are going to raise prices. And in fact, they'll try to take advantage of that. And if we depreciate 10%, they'll raise their prices 20%. So their argument was that, in fact, the nominal depreciation would be counterproductive. It would actually lead to real appreciation. And they'd have the political headaches associated with starting a bout of inflation. So it's also important to recognize it takes a little while to find out if a nominal depreciation translates into a real depreciation, because typically what will happen with a nominal depreciation is the price of imported goods will adjust fairly quickly. And so you will certainly see typically a jump in the price level. But the question is not whether the price level jumps, but whether you get sustained bout of inflation. So do you actually keep the real depreciation from happening through sustained inflation? So something that you can look at, and if you're doing I don't know if anyone's actually doing this for your capstone project, I did have a student do this, looking at exchange rate pass-through. In fact, he was Trinidadian. He was looking at the very policy question that I just mentioned, where was the Trinidadian government right to worry that a nominal depreciation would just lead prices to be more than offset? And so you can look at something called exchange rate pass-through. Exchange rate pass-through is the idea that if you make foreign goods more expensive by depreciating the nominal exchange rate, does that pass through to prices generally? And you can summarize that through a pass-through coefficient. And it's a pass-through coefficient is telling you the proportion of the nominal depreciation that passes through to domestic price increases. One of the issues that was faced by countries, including those countries that had crawling pegs that I mentioned, if they started depreciating their exchange rate, if you have a lot of prices in the economy, or particularly wages, they're actually tied to the nominal exchange rate, and you're kind of chasing your tail. You depreciate the nominal currency 5%. Well, if unions say we get to be compensated for a nominal depreciation, so there's a nominal depreciation of 5%, that means our wage settlement has to be 5% higher, then it's going to be very difficult to prevent that exchange rate depreciation from passing through, and you're going to have a hard time actually depreciating the real exchange rate through a nominal depreciation. And in the worst case scenario, you set off higher inflation because wages adjust, and that leads you to need to depreciate the nominal exchange rate, and that leads to another wage increase, and leads to more inflation, leads to another nominal depreciation increase, and so on. You end up what's called a sort of wage inflation, price inflation, depreciation spiral, and it doesn't end. So that's a problem. So sometime in my lifetime, I think in the 80s or 90s, in recognition that this was a phenomenon that was happening sometimes, and particularly in Latin American countries, the idea was you need some sort of what's called a nominal anchor. So you target some nominal variable, because if the exchange rate's depreciating and prices are rising, and you keep doing that, there's nothing to kind of stop that spiral unless you target a specific nominal quantity. And then you can anchor the, instead of getting a wage depreciation spiral, at some point you anchor that. So some sort of nominal variable that you target. It may be just that you target a specific price level, or you may target specific wages, or you may target a specific exchange rate and try to use that to stop these spirals. But achieving that kind of target, you typically need to reduce demand in the economy. And so that brings the other type of policy, which is an expenditure compression policy. So typically you're going to reduce demand through some sort of fiscal policy, reducing fiscal expenditures or raising taxes. And so so what we looked at before was countries with fixed exchange rates just being able to use fiscal policy, and a couple of the questions on the exam set that scenario out. If a country has a fixed exchange rate and it needs to adjust fiscal policy, can it pursue both external and internal balance at the same time? And one of the examples I set up, there was a conflict between those, and the other one there wasn't. So if you remember that, you might figure out whether you got those two questions right. But that's a situation where you don't have any expenditure switching policies. If you are willing to adjust the exchange rate, then you can pursue both external and internal balance typically by pursuing external balance with the exchange rate, expenditure, switching policy, and internal balance through expenditure compression policies. The idea is you need two policy tools to pursue two targets at the same time. All right. All right. Now, suppose you've succeeded in making the nominal depreciation stick. In other words, you've done a nominal depreciation. You've prevented prices from rising too much. So you've got the real depreciation. But even then, you still have to ask, does that actually improve? And I'm going to say the trade balance here on the idea that a trade balance improvement will probably translate to a current account balance improvement. Probably the primary and secondary income accounts aren't likely to be as affected by exchange rate policies. So we're going to focus on the trade balance. So whether a real depreciation succeeds in improving a trade balance is going to depend on trade elasticities. In other words, how much do exports and imports respond to depreciation of the real exchange rate? And so a trade elasticity, if you don't know what's the percentage. So an export elasticity is what percentage of exports change when you have a 1% change in the exchange rate. Right? And so the more responsive trade is to the exchange rate, the more effective real depreciation will be. Because the idea of real depreciation is to try to increase exports and decrease imports to improve the trade balance. I hope you learned this in international monetary theory, the Marshall-Lerner condition, which was invented, I guess, separately by Alfred Marshall in the 19th century and Abel Lerner, economists in the early 20th century. And I don't quite know the history of how they developed this or how they figured this out, but the Marshall-Lerner condition is a rule about those trade elasticities that tells you whether depreciation will actually improve the trade balance. And the rule is simple. It's just the export plus the import elasticity has to be larger than 1. It's not that hard to prove. I'm not going to do it here. But if the Marshall-Lerner conditions are met, then a real depreciation will indeed translate into adjusting the trade balance. And so in most cases, and there's plenty of empirical studies to say that usually the Marshall-Lerner condition, almost always the Marshall-Lerner conditions are met. So it may be that they're not met, and actually then the problem with the depreciation is that it makes imports more expensive. So yes, you're reducing the quantity of imports, but you're increasing the price of imports. And if that effect overwhelms the improvement in exports, then it could be that depreciation actually worsens the trade balance, but that's a pretty rare case. There is something called the J curve, again, something hopefully you'll learn in international monetary theory, which is elasticities change over time. In the very short run, the depreciation may not lead people to adjust their import habits. I put Godiva chocolates there. There's something called habit persistence, which says even if something becomes more expensive, you may continue to import it just because you're used to importing it. I actually don't eat that much Godiva chocolate, but I wish I did. And if I, had a taste for Godiva chocolate and the dollar depreciated against, I guess they're made in Switzerland. I'm not sure where Godiva chocolates are from. Let's say the dollar depreciated against the Swiss franc, and Godiva chocolates became more expensive. I may not react by reducing my consumption at all in the short run, but eventually I will. And so over time, the elasticities tend to increase. Same thing with exports. If your exports become cheaper, it's going to take foreigners a little while before they buy more of it. There may also be contracts that fix the amount of exports and imports that are traded. So anyway, over time, the elasticities increase. So in the short run, and if you can see this J curve, in the short run, depreciation may lead to a larger trade deficit or current account deficit. But as the elasticities increase over time, it's very likely the Marshall-Lerner conditions will be met, and eventually a real depreciation will translate into an increase in the current account balance. And so that's what's shown in this chart over time, that initially the Marshall-Lerner condition isn't met, and a depreciation leads to a larger current account deficit. And then as the elasticities increase as people change their habits, as contracts run out, and businesses are able to take into account the new prices. The Marshall Lerner condition is more likely to be met, and the current account balance improves over time. So usually in IMF programs, the assumption is the Marshall Lerner conditions will be met. The J curve, if it exists at all, won't be that long, and therefore a combination of expenditure switching and expenditure compression policies are typically what are recommended by the IMF to try to help adjust the current account if there's suddenly a large current account deficit, or if it can't be financed. So if you look at the policy conditions that are in a typical IMF program, a typical one meaning it's addressing an unsustainable current account deficit, there will be some combination of fiscal and exchange rate fiscal and monetary policies for expenditure compression. In other words, try to restrict both public sector and private sector demand, and expenditure switching policies to encourage foreigners and domestic residents to buy more of your stuff and less of foreign country stuff. Further considerations, let's see where I am here. We'll I'll get through this and we'll take a break. So you should be aware of exchange rate regime. So fixed exchange rate regime versus a floating exchange rate regime. Oh, sorry, cursor wasn't working. Right. So fixed exchange rate, again, this is just a review from international monetary theory. The monetary authority, meaning the central bank, is committing to selling foreign exchange at a specific price, and it will have to sell its stock of foreign exchange reserves as needed to be able to sell a foreign exchange at that price. So all a fixed exchange rate regime is the central bank promising to sell foreign exchange at that fixed exchange rate. The problem is what causes a central bank to be possibly breaking that promise is that they may be running out of central bank reserves, right? And that's what we were talking about in the gold standard period. In those days, the central bank reserves under the classical gold standard were gold. And so a country running out of gold, its ability to defend its fixed exchange rate, in other words, the price of its currency in terms of gold, if it starts to run out of gold, that commitment may come in doubt, and the country may have to devalue. And in fact, that's exactly what happened in 1971 with the United States. Nixon had to devalue because its holdings of gold had fallen below the dollars that were being held abroad. Most of you got that right. And there's the classic model of, this is called the balance of payments crisis, when country runs out of reserves and has to devalue. The reason, probably the most important reason Paul Krugman won the Nobel Prize is he developed the canonical model of balance of payments crises, and it's from 1976, doesn't say there. But that's a landmark article, and that particular model has been elaborated in all kinds of ways. But Krugman actually developed the first model of why and under what circumstances and how quickly a country can run out of central bank reserves. So a lot of developing countries, we're in a world mostly of floating exchange rates, as we talked about when the Bretton Woods era came to an end definitively in 1973. I call that the floating rate era, but a lot of developing countries still do peg their exchange rates. And the IMF does an annual report outlining every single country's exchange rate regime. It's called unfortunately, almost spells arrears, AREAER, in that report. If you want to know specifically what a country's foreign exchange regime is, you can look at that. So a pure floating exchange rate regime, the central bank doesn't intervene at all. It doesn't buy or sell foreign exchange. It doesn't care what happens with the exchange rate, and so the private markets determine the exchange rate. So that's the way the US dollar is determined. That's the way the euro and the yen and pound sterling is determined. Those are pretty pure floats. I mentioned the Plaza Accord, which was a very rare case of intervention, but for the most part, the major industrial currencies, the industrial country currencies are purely floating exchange rates. Now, the euro area, you could regard the euro area itself as a fixed exchange rate regime within the euro area, very credible fixed exchange rate regime, because countries don't even have their own currencies. They share a common currency. So, Italy can't devalue against France because they both use the same currency. But the euro floats against the euro as a whole, and therefore the euro area as a whole floats against other currencies. And then you can do all kinds of intermediate regimes where you have some rule about foreign exchange intervention by the central bank that falls short of an absolute nominal pegged exchange rate, and various regimes. And I mentioned the crawling peg, for instance, one of them, but I won't go over those. All right, let's see. Okay, and so this is the last slide, and then we'll take a break. So I said, the key to financial programming is it forces consistency across sectors. And so the external sector has some links to other sectors. I just want to we'll do the last lecture. We'll go over these various links across sectors comprehensively, but just to let you know right now, what are some of the links? So, and these are, when I say links, I mean literally of the financial programming exercise, you're going to have spreadsheet links where a number in the external sector accounts has to match a number in the other accounts. Or it may be that you have a number in the external accounts that feeds into the real sector accounts through some behavioral equation. All right, so links to the real sector. So if you have higher absorption in the real sector, so in other words, either there's an increase in consumption demand or investment demand that the real sector economist is projecting, that is going to have to translate into higher import demand. So if the real sector economist says something's going to happen to change consumption or investment behavior, the external sector economist is going to have to put that through some sort of behavioral equation to say how much does that increase in demand translate into imports. In other words, how much of the increase in demand is going to be met by the domestic economy, but some of it is certainly going to probably be met by imports from the rest of the world. You can look at it the other way. What about a demand shock from the rest of the world? So big demand shock now from the rest of the world, and the demand has dropped across the world. So that means countries that rely on exports are going to find most likely that it's more difficult to export to the rest of the world, because the rest of the world has kind of come to a standstill and demand has dropped precipitously. If there's higher demand from the rest of the world, then that will lead a country to increase exports. So there was a period that I was working in the Caribbean, and after the financial crisis, there wasn't much demand for tourism from the Caribbean. But the further away we got from the crisis, and the more people in the U.S. accumulated wealth because the stock market was rising, for instance, the more people were willing to take luxury vacations to the Caribbean. And so we would have to look at what was happening to demand in the rest of the world, and that would partly translate into higher tourism exports for the Caribbean. You may look at how changes in foreign prices that may raise domestic CPI inflation, for instance. So all these links that have to be at least considered in a model. Links to the fiscal sector. So again, we talked about the twin deficits earlier, in the condition under which a higher fiscal deficit increases demand for imports, and therefore it may lead to a higher current account deficit. So typically, the fiscal sector will be linked to the external sector by maybe there's some rule about how much a higher fiscal deficit translates into a higher current account deficit. Remember, it's not one for one, because it depends on whether private sector savings and investment adjusts. So higher trade volumes can translate into higher government revenues. So a typical thing would be, the U.S. doesn't rely much on trade. In fact, most industrial countries don't rely much on import taxes. I have to modify that a little bit because there's been a trade war, and there's been a big hike in tariffs over about the last year and a half. So, and in fact, that's what Trump keeps trumpeting, is that one of his reasons for imposing tariffs, he says, is it's bringing in all kinds of government revenue, which he's actually, I think, vastly overstated. But it is true, higher tariffs have brought in some higher government revenues. Other countries that have less liberalized trade, in other words, they have much higher tariffs, changes in imports can actually have an important impact on fiscal revenues because countries, they may have high import taxes and they may have a large volume of imports relative to the size of the economy. Certainly another link that has to be considered is the government may be financing its government deficits through external borrowing. So that's going to increase capital inflows. And so actually that generally is a number that the external sector economists, they will look at financial flows and they will usually break it down into government financial flows and private sector financial flows. And it's very difficult to figure out what's going to happen with financial sector flows. But government financial flows are very easy because you just say, you ask the fiscal economist how much debt are they repaying and how much do they intend to borrow. And you just plunk those numbers right into your public sector financial accounts, the financial account of the balance of payments. Links to the monetary sector. I mean, we're going to discuss the monetary sector later. So more capital inflows are going to increase the monetary base, may be inflationary. And then changes in interest rates, if those are going to be modeled explicitly by the monetary sector economist, higher interest rates in the domestic economy are going to attract probably more financial flows. Lower interest rates may lead people to take their capital out of that country and put it in another country. So you may have the financial flows, the private sector flows typically in the external sector, the external sector economist spreadsheet may be linked to interest rates. So, all right. So, sorry, that's the end of this lecture. So, sorry, this took a little longer than I hoped, but I've got 3:36. I don't know how everyone's doing. I can only see a few of you. Hopefully, everyone's still with us. But anyway, and I haven't seen anyone use it. I don't know if I missed anything. I haven't seen anyone using the chat facility, so I'm going to stop sharing that. So let's just take a 5-minute break and be back. Well, in 5 minutes, and we'll start the next lecture on the government sector. Let me see if I can end that. I'm just going to disappear for a few minutes, and yeah, just be back in 5 minutes. Sorry. Okay, be right back. All right, I'm back. Exactly 5 minutes, so I have to run up to the kitchen to get a very stale granola bar. So, you can just take a, I saw I had 3 people who had their video on. Again, if you're comfortable turning your video on, it's great to see your faces, but if you're not comfortable, that's fine too. So, hi, Jean, you're back. So, all right. Let's see her coming back. So let me start lecture 6. So I'm a little, well, about half the lecture behind where I'd like to be, but we'll just find a way to catch up at some point. So, all right. Let me say, I have to share my screen. So is this it? All right, so let me see who I can see. All right, I can see Roberto and Jean. Jean, can I ask you if you can just give me a thumbs up? Can you see the PowerPoint that says government sector? Okay, great, thanks. All right, so this is lecture 6. And so this is the third sector we're looking at. And let me see, I'm trying to see how long this lecture is, because I've forgotten. Yeah, this is shorter than the external sector. So hopefully we can, the plan was to start this today and hopefully finish it next time. Hopefully I can do that. And where's my, okay, there we go. All right, so what are we going to talk about? First, we're going to just introduce the government sector. What it actually is. It may seem obvious, but actually there's a few things that one needs to consider in terms of thinking about the scope of the government sector. So most of the lecture, just most of the external sector lecture was about the balance of payments accounts. Most of this lecture is going to be about the fiscal accounts. And just as for the external sector, there are flow accounts, which is the balance payments, and stock accounts, which is the IIP, the international investment position. The fiscal accounts also has a flow and a stock counterpart. The flow part is the statement of government operations, and also something called a statement of other economic flows, which is something that is needed to kind of square the accounts, but isn't as important. And then the stock account here is the government balance sheet. Now, in the case of the external accounts, the international investment position actually used to be very difficult to get data on it, and the IMF Statistics Department did a lot of work to try to help countries be able to collect that data. So actually most countries do have international investment position accounts. You might think it would be easy to do the fiscal accounts that way, the government balance sheet. In my experience, very few countries have reliable government balance sheet data. It's a bit of a surprise because you think it might be, the government's a single entity. It should be set up to provide data and know what assets and liabilities it has. And usually liabilities are not a problem. Although I've been to countries where they actually literally didn't know what they owed to the rest of the world. They had poor systems for tracking for, government loans, for instance, foreign government loans. So I've worked in countries where they actually asked us to help figure out what they owed, which is a little strange, but anyway, that happens. But governments often don't have a very good handle on their assets. And a lot of times those assets are not very liquid assets. And so it's hard to know, for instance, how much a lot of governments own a lot of land or a lot of buildings, how much are those worth? So that may be hard to accumulate that. So all that's to say that the stock accounts here, the government balance sheet, are not as important as the IIP is, or at least, and they're certainly not as reliable. All right, and then the last thing we'll talk about, same thing we did, these analytical tools for vulnerability that we just did for the external sector. We're going to look at some analytical tools for the government sector, again, aimed primarily at, aimed at least in part to say how sustainable are government finances. We're also going to look at an important topic, which is to look at a cyclically adjusted fiscal balance. In other words, sometimes the state of the economy can impact the government budget, and so you want to understand what is that impact. And in fact, if the government were operating, if the economy were operating at a full employment level, what would that do to the fiscal balances? And so that helps you disentangle the effects of the economy on fiscal balances versus the effects of deliberate government policy. And something that I wish was sort of more well understood in the public debate about fiscal policy. Just an example, people will say President Obama was terrible because he ran up these huge fiscal deficits and ran up the US government debt. But of course, he took office at a time when the economy was collapsing, and that was greatly harming U.S. government revenues and also leading to more government expenditure. So you have to understand the impact of the Obama administration's policies on the fiscal balance. You have to understand how to adjust for the state of the economic cycle. And same thing with Trump. Fiscal deficits are kind of large under Trump, but until recently, they would have been larger if the economy weren't running at full steam. So you get very misleading senses of government, the impact of government policies on the government budget if you don't cyclically adjust them. So that's an important topic that we'll take up at the end of this lecture, which will be certainly next week. All right. So in terms of readings, this was something that I actually kept forgetting to specify last year, so I'm glad I remembered to do it this year. Chapter 5 in the Financial Programming Manual, or whatever it's called, right here. Sorry. Financial Programming and Policies, Volume 1. So it's right there. Financial Programming and Policies, Volume 1. Essentially, the setup of this book is descriptions of the accounts, and then they will give you some tools to predict, to forecast those accounts. And those are kind of like best practice tools that for a lot of economies, you just don't have the data to use those tools, or else they get into techniques that you may already know, but that I wanted to focus in this class primarily on understanding the accounts and asking some basic analytical questions. And this class is not about forecasting. So there are other classes about that. So sections 5.4 to 5.6, I think, as I recall, or at least in part about forecasting, and you may want to read them. There's some useful stuff in there, but in terms of what's going to be on the final exam, it's going to be the first 3 sections, and that's what we're going to cover in this lecture. All right. Okay. All right, so let's introduce the government sector. So start with the basics. So something you don't need to be told, but what is the government's role? Well, its main role is 2 main roles. One is to produce goods and services. So there are public goods that the government is good at providing that the private sector probably isn't good at providing. So safety and security. So armies and police are generally not privately provided because it's too easy to, they would be underproduced for private, if they were produced by the private sector. And moreover, you don't want your police to have a profit motive, because then they will be going around extracting bribes because of the power that they have. So there are, of course, policemen around the world that extract bribes, but you generally don't want that. So the government is the right sector to produce the services that you get from police and military. There are all kinds of examples. Environmental protection, so the things that may be needed to protect the environment, it may be not easy to capture the revenues from that. So it may be something that the government is better able to do. So one role of government is to produce goods and services. A second role, which is accepted in, I think, all countries to one degree or another, is to redistribute income, right? So you want to protect the poor, the ultra wealthy, you may want them to make a larger contribution. So there will be all kinds of programs in different countries to tax the rich and provide services or provide extra income to the poorer segments of society. And that's a role that very much depends on ideology. So you go to a place like Denmark or Sweden, and there's very large amounts of income distribution. There's less in the United States because the ideology of the United States tends to be less in favor of income distribution. Something that, by the way, is certainly being highlighted by the pandemic. So there will certainly be more income redistribution from the government now. And in fact, the legislation has already been passed, and people are getting income transfers from the government. And at some point, the taxes will have to be raised. So the two. So I see I put these bullet points as second and third. What the government's role is to finance that role. The main tool is to raise revenues, mostly through taxes, but through some fees. So things like the national parks in the United States charge fees. There are other things where the government charges fees. Not so much in the U.S. Not so much in most countries. Usually the taxes are going to be the main tools for raising revenues. And that to the extent that the government can't or doesn't want to raise enough revenue to pay for what it produces and what it wants to redistribute via transfers, it will need to borrow to finance those activities. All right. So just a quick overview of what the governments do. So we talked about already what internal balance is, and most of you got this right on the exam, although it was pretty easy because I had a explicit answer in the PowerPoint. So talked about full employment at a low inflation rate and hopefully a stable inflation rate, and that the government's debt is sustainable. Private sector debt as well, but government debt is what people typically focus on when they're looking at internal balance. What is the government's role then in maintaining internal balance? Well, one thing is that the government's production of goods and services entails adding to or subtracting from aggregate demand. So those who believe in activist fiscal policy, and that tends to be Keynesians, people who believe in the ideas of John Maynard Keynes, who identified that sometimes a lack of private sector demand, or when there is a lack of private sector demand, that can be offset by increased public sector demand. So the role of the government in calibrating aggregate demand is something that is usually pointed to in the government's role in maintaining internal balance. In other words, when there's high unemployment, the government should try to increase aggregate demand. And of course, that is exactly what's happening now. The government is sending out checks of $1,200 to people, hopefully including the daughters. Hopefully, well, I guess those of you that are U.S. citizens may be getting that, but all kinds of other tools to try to increase aggregate demand, some of it coming through the Federal Reserve. Okay, so governments have roles in debt markets. Typically, government debt is going to be the largest component of any private debt market. Any national debt market. So the U.S. is a bit unusual in that the largest component of debt, it is the U.S. borrowing, the U.S. government borrowing, but there are also very large elements of the debt market that are private for housing. But in most countries, the debt that the government issues dominates the debt markets, and so the critical question is the government debt sustainable? All right. So put this as a key question. It's a key question, but it goes to that question of looking at the flows versus the stock accounts. And the question is, are the government's flows working to increase the government network or decrease the government network? So, well, I'll leave it at that. But basically, is the government running deficits or they're running surpluses, and if they're running deficits, then they're eroding government net worth, and they may need to raise taxes in the future to keep government net worth from eroding too much. All right, so that's the introduction, very short and probably nothing that you didn't already know. Let's start looking at the fiscal accounts. And so just like with the external accounts, we have to look at the consistency between the stock accounts and the flow accounts. Speaking of liquidity, hold on one second. All right. So that was once at a party, by the way, for professors and students in London School of Economics, and I still remember a professor grabbing a big beer and saying he believed in the importance of liquidity. So, all right, so stock and flow consistency in the government account. So we talked about that with the external sector. Any change in stocks from the beginning of the year to the end of the year, you have to figure out what the flows are. You have to account for those. So I said in red, I'm not. Oh, okay, yeah, sorry. I've got a graphic that's going to show up in a second. So the statement of government operations, SGO, and that's highlighted, so you should know what that means. That's the basic fiscal account. So when you talk about the government budget, you're really talking about the statement of government operations. When you talk about whether the government is running a deficit, a budget deficit, a fiscal deficit, budget and fiscal deficit mean the same thing, or a surplus, you're looking at the statement of government operations. And so running a surplus, other things going to be equal is going to add to government wealth, and a fiscal deficit is going to be subtracting from net government wealth. But I said other things equal. There's actually another account, and so here's the graphic that I actually should show in the beginning of this slide. There's another account called the statement of other economic flows, which is just what it sounds like. There are other things that actually can change the government's wealth besides the fiscal operations. So we'll talk about that briefly. And it's kind of for completeness sake. It's not such a critical thing, but there can be other volume changes. So discovery of a new mine that is owned by the government, for instance, that increases the government's wealth, but it's not a sort of fiscal policy or fiscal operations. Somebody discovers gold deposits or something, and it happens to be on government property, so all of a sudden the government is richer, or government property may get destroyed. There are also valuation changes, so government owns a building and all of a sudden that becomes a much more valuable building or becomes a less valuable building. So those other statement of other economic flows, we'll touch on those briefly, but just so you're aware, it's not just the government budget that contributes to changes in wealth. So this little flow here, whatever the stock is at the beginning, it's mostly going to be affected by the statement of government operations, the budget, but there's going to be these other things that we have to take into account that impact the government balance sheet, and those other flows will add or subtract from the balance sheet, and that ends with the whatever the government's balance sheet is at the end, whatever the government's net wealth is at the end of the period. All right, so the statement of government operations is the most important because that reflects actual fiscal policies and also reflects the impact of the economy on the budget. Statement of other economic flows, like I said, is these other sort of funky things that unless you're actually actively tracking the government's balance sheet, which, as I said, most countries, so far as I know, don't, you're not going to spend a lot of time thinking about those things. Unless there's some really, really dramatic event, hurricane or a volcano that significantly impacts a lot of government assets, for instance. All right. So I'll start with just some accounting rules, and some of this stuff is new. Some of it is stuff we've already talked about. There is Government Finance Statistical Manual. This is produced by the IMF, and it is the manual that is supposed to be used around the world by governments to figure out how to develop the fiscal accounts. I certainly haven't read the whole thing. I dip into it when I need to know something, and it's hundreds of pages. There's a reference to it in this syllabus. Absolutely not something that I would suggest you download or read. But if you have a specific question, and sometimes students do have a specific question about fiscal accounts, almost certainly it is a case that has arisen before, and it should be in that manual. And that's how it's put together as unanticipated things happen, and the a manual has to address those unanticipated things. How do you account for that in the government? It ends up going in the Government Finance Statistical Manual, GFSM. And if you end up in the Fiscal Affairs Department of the IMF, and you actually end up as a technical advisor, let's say, that's going to help countries properly do their fiscal accounts, you will use that as your Bible. Right. So these things aren't updated very often. You can see the latest one is 2014, and I do check that every year to make sure it hasn't been updated. But the previous one was 2001, so it's kind of you do a manual, and you only update it when there have been enough changes to the world that it merits updating. So that 2014 manual, hopefully we won't ever have to cite another manual. It'll retire before they change it again. One of the realities is that the government accountants often don't follow everything in the government financial statistics manual, and neither does IMF staff. So IMF staff are generally kind of subject to however the government does its its fiscal accounts. So if the government isn't following the GFSM, probably the country team won't either. So to some extent, what I'm going to be talking about, most of these things that I'm going to talk about are not controversial, but there may be a few things here or there that are in the Government Finance Statistics Manual, but you may go to a country and they don't actually do their accounts that way. And like the other elements of statistics, one of the things the IMF does is it tracks compliance with these standards. And this was a bit shocking that by 2017 implementation, and I guess I'm trying to remember, I think this is implementation of IMF staff reports. Are they actually following the Government Financial Statistics Manual? It's just over half of them are. So just again, a kind of reality check. So what I mentioned at the beginning, most governments don't report balance sheet data, and so if government doesn't report that data, the IMF can't either. So only about 15% of IMF staff reports actually do report that government balance sheet data. Contrast that with what I said, which is the international investment position now is reported by the large majority, almost all IMF countries report IIP, but very few report government balance sheet data. So I'm going to talk about government balance sheet, but I don't want to put too much emphasis on it for that reason. All right, so some principles of fiscal accounting. So we already talked about accrual accounting. I'll just touch on that briefly, but we need to talk about coverage because there are different levels of the government. And then we need to talk about how to consolidate those. So you may want to look at an individual component of the government, but you may also want to aggregate those together to understand how the whole public sector's accounts look. And then some valuation issues, which we'll touch on. So I am a little bit colorblind, and I'm specifically red-green colorblind, and occasionally I will run across a chart. I'm running across a lot of charts these days that don't cater to people who are colorblind. Running across a lot of pandemic-related charts where I can't even tell what's going on, but I can make this one out. But anyway, what this is, and I got this from an IMF report. It shows countries that do cash accounting versus countries that don't do cash accounting, so presumably accrual accounting. And again, just to remind you, accrual accounting is the better way to do it. So as soon as you get an obligation, that you put that in your accounts, or as soon as you have a revenue, you put that into accounts, even if you haven't gotten the money for it yet, or you haven't paid for it yet. And I think I told the kind of horror stories of Trinidad and Tobago where they just use cash accounting, and they actually have very, very poor records of what they actually owe to contractors who've done work for the government, to the point where there are these messy disputes. Contractor will say, hey, we did 3 weeks of work paving a road, and we haven't been paid yet, and it was 6 years ago, and the government has no records because it doesn't use accrual accounting. It never put the obligation in its budget when the road work was done. It couldn't pay it, and so it didn't see the money going out of its bank. So it never put that particular bit of work into its budget, and so as far as it knows, it doesn't owe that money, but in fact does owe the money, and so the fiscal accounts can be very misleading if you just use cash accounting. Same thing like, if you were doing your personal finances and you had a huge bill to tax authorities, or you had a huge credit card bill, and you ignored that, it would make it look like your personal accounts were better than they actually were, just because and especially if you couldn't afford to pay the bill, and you ignored it, that would make your personal accounts look a lot better than they actually are. So it's important to use accrual accounting, but you could see quite a lot of countries still use cash accounting. I see China, if I'm not mistaken, does cash accounting, which I never focused on before. I don't know if that's still true. That's surprising to me, but you can see it's mostly Latin American countries and African and Middle Eastern countries that still use cash accounting. For the most part, all of Europe, US, Japan, Australia, and so on use accrual accounting. Accrual accounting is harder to do, by the way. Cash accounting is easy. You just see what's in your bank account. So, all right. So coverage of the fiscal accounts. So this is maybe the only slightly tricky thing about this first part. There are going to be different levels of government. So we probably think of the central government as being the government, the national government or federal government if you're in a federal system, but there are usually subsystems of government. So in the U.S., we have state governments that are quite large, and California's, I think, something like would be the fifth or sixth biggest economy in the world if it were a separate country, for instance. So in the United States, some of these states are quite important, and so you need to perhaps follow the state government's finances separately. Provincial governments, so Canada has provinces, that gets counterpart of that. And then there are also local governments, which will keep separate accounts. So, I presume Paris or London or Munich or Tokyo all have their own government accounts. And so it may be important to link those, because sometimes the central government may actually have to meet the liabilities of a smaller government sector if that smaller government sector can't pay. So, for instance, Detroit in the United States defaulted on its debt, I think, a couple of years ago, and the U.S. government had to bail it out. So it was important for the U.S. government to know what the debt of that particular local government is, that particularly local city. Those are the levels of government. And then there are also public corporations that aren't sub-governments, but they're separate entities, but they happen to be owned by the government. So public corporations, sometimes they're called state-owned enterprises, SOEs. I haven't heard this term in a while, but when I was undergraduate or much younger, we used to call them parastatals. There are things called statutory corporations. So there are all these different corporations, but if they have either majority government ownership or maybe total government ownership, then again, that may be something where the central government may be on the hook for a default by a public corporation. That happened again in the United States when Fannie Mae and Freddie Mac were taken over by the government. They were perceived as having government guarantee, being backed by the government. Legally, they weren't, but the U.S. government took them over during the financial crisis of 2008, 2009. So they are, at least for the moment, are explicitly public corporations. And so there's two basic kinds of corporations. There's financial corporations. So those are divided further into monetary corporations, which essentially means the central bank, and if there are government-run banks, which there certainly are in some countries, and then there are non-monetary financial institutions. So this will typically be a development bank it doesn't take deposits. It's just a bank that funnels money from the government for development projects. A lot of countries will have a government-owned agricultural bank because farmers may have difficulty borrowing from private banks. So a government, in order to support its agricultural sector, which of course is viewed as essential in pretty much all countries, if farmers are at some risk of getting their access to finance cut off, a lot of countries will set up a state-owned, government-owned agricultural bank to make sure that those farmers can still have finance and plant crops and feed the country. So those are financial corporations, and then they're non-financial corporations. By far, I think by far the most important are going to be resource extraction companies. In other words, most of these are state-owned oil companies. So I've mentioned some of them. I mentioned Pemex in Mexico, the state oil company in Norway. PDVSA is the state-owned, wholly state-owned oil company in Venezuela. There's Codelco, which is a company owned by the Chilean government that is the sole copper producer. It's certainly the major copper producer in Chile. So resource extraction companies are typical. There'll also be utilities, typically government-owned. They're typically monopolies. It's often the case you can only have one water company in a region or one power company in a particular region. And so to avoid them extracting monopoly profits, the government will own them. And then there are others, and there are certainly places where there are state-owned corporations that there may not be that much public rationale for the state-owned company, but the government just for historical reasons may own an automobile company or may own a retail outlets or whatever. So public corporations typically have a separate set of accounts, but you may want to integrate them because if a public corporation fails, the government may have to bail it out. So you want to know the position of those. All right, so how do you consolidate fiscal accounts? Well, it's very easy, and it's basically the same rules for both flows and stocks. So you want consolidated public accounts. That's called general government. So typically you're combining the central government and the state governments. And so what you have to do to consolidate is you just have to eliminate transactions between levels of government. And, typically, not typically, I would say universally, there are going to be some transactions between the central government and smaller sized governments. There may be some sort of transfer arrangements. So again, the United States the federal government makes various grants to state governments. And so that's a revenue for the state government, but it's an expense for the central government. But when you combine those two, it's just a wash. So you would need to eliminate those. All right. So you consolidate these accounts by eliminating those intergovernmental transactions. So this is the example I just gave in that bullet point of central government is making grants to the state government. Then you eliminate them in central government expenses. And I had this summary. Yeah. So if you look under central government, you'll see grants. Those are being made to states, and that's an expense for the central government, a revenue for the state government. So when you consolidate the general government, you can see that those are eliminated. So the grants for the central government's receiving 20 of grants from maybe a foreign something, from the United Nations or whatever. State government is receiving 40 in grants, but those 40 in grants are being received from the central government, so you don't count those. So the general government, meaning the two components of government together, you only count the central government grants that are coming from outside and not the state government grants that are coming from the central government. And then if you go down to the expenses, again, you eliminate those expenses from the central government, the grants that are being made to the state governments, because general government consolidating both of them, just moving money from one pocket to the other pocket, but it doesn't change the amount of money that the general government is spending. All right, now stock accounts, just the same thing. And again, we won't spend much time on stock accounts, but that's assets minus liabilities. And so if one government unit has claims on another government unit, you just eliminate those. So a typical thing will be when you consolidate the public sector, and I should have said this first, adding the central government and state and local governments leads to the general government accounts. If you add in public corporations, then you've got the full public sector accounts. So that's the public sector accounts refers to everything combined. General government is excluding public corporations. All right, so public corporation, as I said, it will typically include the central bank. Well, the government may use the central bank as its bank, and so it'll put its deposits in there. And so it's an asset for the general government, but it's a liability for the central bank. So again, you would have to eliminate those when you're adding up the public sector. So where have I done that? Let's see. Yeah, so if we look under, let's see, yeah, I circle that. So general government has deposits in the central bank of 100, which is an asset of the general government. You see I've circled that that's a liability of public corporations to the government. But it may also be that state-owned bank makes a loan to the government, and I've got that as 500. So that's an asset of the state-owned bank, but it's a liability of the government. So again, when you add up these things, they add up to zero because they're netting out. So that's where you eliminate them. So you see in the public sector accounts to the right of the 100 and 500, and the 500 and 100, there's no entry. It's a zero. All right, so I don't know what that was about. I'm just showing you there's a zero there. All right, so that's consolidation, very straightforward. Valuation principles. In general, anytime you have a balance sheet anywhere in the world, you usually probably want to value assets at whatever their current actual value is, which is whatever you could sell that asset for on whatever the relevant market is. So there's a term called mark to market. What that means is that if you've got an asset, you value it at its current market price, as opposed to, say, its acquisition price. Government may have, like the Bank of England building in London that I guess the central bank owns. I believe that building was built in something like the 1670s. If you valued that bank at its acquisition price, I don't know, be £200 or something. So you'd actually want to value it at the current market price. Like if the Bank of England actually sold that building in London today, what would it be worth? There may be an objective valuation of that, but it may be that you don't know what it's worth because, there's only one Bank of England building, and who knows what it would actually fetch on the market if the Bank of England were to sell it, which it won't do. So you have to make your best estimate of what that building is worth, for instance. But you still try to do that. So that's recording assets at market values. We also record liabilities at market values, but liabilities are financial debts, and so usually you know what it is. It's whatever the liability was issued at. If you borrow $100 million, the liability is $100 million. It doesn't change through market values. Changes in markets, the government would still owe $100 million. Someone else may actually buy that debt for more or less than $100 million, but the government still owes $100 million. So the liability should be recorded at its what's called par value. So if the government does, for some reason, want to record an asset at a non-market value, what it should do, probably won't, but what it should do is it should record, it's not so much with stocks, but with flows. Let's say a government sells state-owned enterprise, and it's happening in Russia when it first opened up. The Russian government owned all these state-owned assets, and it was selling them to these what came to be known as Russian oligarchs, which were politically connected people that were buying Russian government enterprises really cheap, and then they became very wealthy people. So we know there are all these wealthy Russian oligarchs around, and some of them became very wealthy because they were able to buy a valuable state corporation for very low amounts. Well, if that happens, the correct way to show this in the government accounts is to actually pretend that the enterprise was sold at the market value, And so you should record the sale at market value, and then there should be an offsetting expense, which is that you provided a subsidy to the Russian oligarch. So you sold a Russian oil company to an oligarch for $5 million. It was worth $100 million. You should actually say there was a sale of $100 million and then a $95 million subsidy to this particular individual. As you can imagine, the reason for doing that accounting is to have transparency so that if you've sold an asset too cheaply, that in effect you've given something of value to somebody. So you should record the fact that you've given that thing of value to somebody transparently in the fiscal accounts, but typically that doesn't happen because when that sort of transaction happens, the government's usually trying to hide the fact that it's giving a subsidy to someone. It could also be that you sold something above market value, and then you'd record that as a transfer from whoever bought it to the government. But if you're not selling something at market values, if the government's not selling something at market values, that may be doing so for some sort of shady reason, and the government is going to try to hide that and not account for it transparently. But that's how it should be done. Okay, so I've given that exact example there of government selling something cheaply to a political supporter. All right. So market prices may have to be estimated. So I mentioned selling the Bank of England building. A lot of things you just don't know what the value is because it's a unique asset and there's no market for it. So you just have to make your best guess, and you can bring in valuation experts to say what the market price would be. But a lot of times government doesn't want to pay for evaluation experts when they make their best guess. Now, if there's a change in the value of an asset that the government already owns, that should be recorded in the statement of other economic flows. So we'll get back to that, but it's the valuation changes of that. So, and I've already said this last point, the value of an asset can change because the value of an asset will depend on what it can fetch in the market at the given moment. Liabilities generally don't change because if you borrowed a set amount and promised to repay it, the market fluctuating shouldn't affect the amount that you owe, unless there's a debt restructuring and you actually do. The government actually does write down the value of its liabilities. All right, so fiscal accounts. This is kind of a natural stopping point, but since I think I'm maybe 10, 15 slides behind where I'd like, so let me just continue and we'll stop at exactly 4:30. Since I can't see the video, I don't know where I'm just looking at, I still only see 3 of you, but most people still seem to be on, so I guess you're listening. All right, so let's start with the fiscal accounts. So I just started just by showing a statement of government operations. I don't remember why I chose Turkey, but I'm just trying to, diversify my example, so I'm not always showing China or the U.S. Also, now that I do remember why I showed this, because in my first time I taught this, I had a very vocal Turkish student. Some of you may know him. He got the MIEF 2 years ago. I won't say who his name is, but he was a lively fellow. So I think I put this in just because he was Turkish and wanted to make him feel at home. So, first thing to notice. So this is taken from, I think I took it either from an IMF report or maybe from the IMF government financial statistics. By the way, I should mention if you go with the IMF and you look at their data, there are many databases, but one of the databases is specifically about government financial statistics. So this is Turkey. And so first thing to notice, remember the balance of payments accounts are universally going to be in dollars, but the statement of government operations, the fiscal accounts, are always going to be in domestic currency. So you'll see at the top here, it says billions of Turkish lira. I'm pointing with my cursor, which you can't see. So these are transactions that are going to affect net worth. So revenues and expenses, these are the main things. And so we're going to go through these various concepts in here, but we're not going to get very far today. So an important point, this is maybe the most single most important point that of this lecture that I'm going to hammer home and mention many times to make sure you remember. One of the things that the government may do is invest in a non-financial asset. What does that mean? Well, it usually means the government is investing in something. So the government builds a bridge. That's an asset of the government. It's not a financial asset. It's not a bond or a stock, but it is an asset. And so the government is going to have to spend money to build that bridge. But the important point here is that what it's really doing is exchanging one asset for another. It has cash, and it's building a bridge with that, and the bridge still has value. So when the government invests in a non-financial asset, it actually doesn't affect the government's net worth. The bridge is worth initially what the government paid for it. That's how you value it. After the bridge is built, it may fluctuate in value. Like we just said, the market value assets can change. But investment by itself doesn't affect net worth. All right. And then we're also going to talk about the financing of things. So it's either the acquisition of financial assets, in other words, the government is lending, or incurrence of financial liabilities, the government is borrowing, and that doesn't affect net worth. Anyway, we'll go through that a little bit later. But basically, what they're doing, if the government is investing in a non-financial asset, you're exchanging assets, or you may have an asset setting off a liability. So when a government pays down a debt, it's using its assets, probably its cash, to pay off a liability. So its assets fall, its liabilities fall, the net worth doesn't change. All right, so what's really going to impact the government's net worth is its revenues minus its expenses. And so these things are a little bit out of order. So the net gross investment in non-financial assets, this line here is not going to affect financial net worth. It's not going to affect the government's net worth, whereas revenues, expenses are. And then the last point, which is, it's seen on my screen, so that's why I mentioned it first, that the statement of government operations is just going to be in domestic currency. So that's probably all I have time for. Yeah, let's end it there. So we'll start with this next time. So I will get a homework assignment out in the next couple of days, but it won't be due for 2 weeks. It's possible, if I don't get far enough next week, that I may even have to delay the due date another week. But for your sake, that we don't have to do that, because you don't want all the homework bunching up at the end. Just to repeat something I mentioned in an announcement, I guess there was a question about whether you can do homework together in groups, and yes, you can. You can do them in groups. Well, you can do them by yourself or in groups of 2 or 3. And so I think that's it. So for some reason, my Zoom meeting has disappeared. I can't see all of you anymore. I'm hoping you're all still on. But I'm going to end it there and thank everyone. And if you have any questions, let me know. And otherwise, I will see you next week. Thanks, everybody.
Thank you, Professor.
Good. Oh, glad to hear your voice, because for some reason I can't see anyone anymore, so I wasn't sure you're all still there. But see you next week. And again, if you want to talk to me or whatever, we can Zoom bilaterally or email or whatever. So, all right. Thanks.
Thank you.
Thank you.
Thanks. We'll just wait till everyone. Oh, see, I saw a baby there for a second.